Hello, folks. Brandon Chapman with today. It's another edition of TheoTrade daily video night, depending where you're at, I guess. Normally I'm on Mondays, but I'm stepping in for Don today. Kind of busy. We had a holiday on Monday, so hey, why not get a chance to do the video this week? Last week, if you recall, last Monday's video, we talked about why the market, maybe the script is flipping in the market from bullish to bearish. And certainly yesterday did bear some fruit to that regard. As we look at the SPY, let me just bring up the SPX, a little bit cleaner chart right now. But if we look at the SPX, what you'll notice is what we saw a pretty heavy selling day yesterday, right? We finished near the lows. We broke some support levels around 55.60 based on two prior lows on the 22nd and then on the 28th. This is a pretty nice engulfing type formation after a long bullish run that was met on light volume. Right. The fact is we rallied over that period of time. Let's just look forward/ES. That rally occurred. And guess we got it here, right? So this rally occurred on diminished volume. There was not a lot of support behind it, right? We're going into the end of the summer. We're approaching Labor Day. And we had a light volume melt up on a weaker dollar. Well, how do I know the dollar's weak? Just look at gold as a proxy for the dollar. Gold off the lows back on August 7th. Made a nice little run here. And as a result, the fact is the S&P did not rally as strongly as the price tends to intimate. And so all of a sudden we returned back from vacation to yesterday seeing some selling and breaking support. The signal we got back here on the 16th from the volatility markets. If we look at the term structure, the VIX 3M plus VIX ratio, and this just shows the composite symbol, adding the two together. If I add in a pairs ratio study, we'll actually look at the relative strength line. Well, guess what? We hit 1.2 back here on the 16th, meaning what? The 3-month VIX was 20% higher than the spot VIX. It's a proxy for the futures. The futures are pricing in much higher volatility, taking those 30-day weighted two futures contracts compared to the spot VIX. And so when you see this, what the market's telling you is, hey, there's volatility ahead, and frequently you get a 5 to 10% correction off of these kinds of signals if we have relatively high skew. Well, let's go back here to August 16th. So right here, skew is north of 140. Anything north of 130 is high. And what have we seen since? This may be hard to see, but if you notice, the skew has continued to rise. And yesterday, we don't have today's data yet, but yesterday on September 3rd, we're at a 163. We very, very seldom will we ever hit a point higher than that point. Normally, the skew declines when you see the market go down and the VIX goes up. Why? Because people buy puts as protection rather than looking at selling calls as well. So yesterday we had a pretty sharp rise in the VIX, but again, we probably had more put buying. We also had a lot of call selling as a function. The volatility curve shifts up, but the put side shifted up just slightly higher than the call side. So we ended up being more skewed. Normally you see what? Just out there put buying as they're selling while the skew is rising, right? This is saying the tail risk, the downside risk of the market is real. And so the title of today's video is like the vol on edge as S&P tries to hold it together. We're holding it together. And if this is an attempt to scare you, take it as such because it is. I was looking at Twitter today, and someone was posting a tweet. I guess they have a following where they're buying a bunch of high short interest garbage stocks, like a GameStop, for example. They've lost a lot of money, and they're saying, hey, let's step in heavy into this one stock, and we're going to make it back. That's an investing or trading philosophy, right? It sounds like an act of desperation. The reality is times change. The script was flipped back here last week, right? I did the video on the what day was it? 26th, right here, that the script was flipped. Blake and I at our Friday Theo Live, our morning show, talked about how things had changed. Despite the fact we rallied on Friday, we popped and then we dropped. So we have to take the market at face value. We have to look at the volatility of the markets and say, look, hey, VIX is up, yes. But the fact is VIX may go higher. And normally I look at a big pop like this in the VIX and say, yeah, we're not getting north of 30. But what we're seeing right now is really interesting when you start to look at the term structure of the VIX. And I'm going to go back to the VIX term to VIX ratio. And we're seeing as this has dropped really fast yesterday. And right now we're about 1.03. What that means is that the 3-month VIX is only 3% higher than the spot VIX. This has more room to go down. And this generally falls as the market falls. Today we're down 0.2%. We probably have more room to go for this to get down here, a la what we saw on August 5th, where this dropped down here below 0.9, meaning what? The 3-month VIX was below the spot VIX. The market was pricing in lower volatility in the future. Well, we go to the product depth curve here. We look at the VX. This actually just flipped a little bit. It's pretty flat right now. But a few minutes ago, this right here was higher up here, and we saw full backwardation, right? Going back 3 expiration cycles. Oh, here we go right there, right? So essentially, we're in a very slight backwardation. You can see back here, this is August 5th, a much steeper backwardation where the front contract was up here at 29, then we dropped to 27, 28, then we dropped down here to 24. This is a very slight backwardation. And what that means is this go round, this may not be the buying opportunity that you think it might be. Go back to August 5th back here, VIX and backwardation. The 3-month VIX was below the 30-day VIX. We're not the same position today, right? The 3-month VIX is not below the 30-day VIX. And the VIX, yes, it's in VIX futures or slight backwardation, but the fact is it's pretty flat. We're nowhere near where we were on August 5th. So what you might want to see right now, you might want to see this, again, we're in backwardation. You might want to see us get back to more of a normal cycle. Now, a normal slope curve, which is what? Upward sloping, unlike what we saw on the 5th and unlike what we're seeing today. Okay? The realities are right now we're barely hanging on. And guess what? We have a jobs number this week. JOLTS data came in underwhelming today, 7.67 million versus 8.09 million expected. We're seeing job openings have come in a fair bit, a lot since the 2022 highs. And we've seen employment data soften. But yet we still have this week, we have unemployment claims coming up tomorrow. We got the ADM report tomorrow. We've got some ISM data tomorrow. Again, the ISM's angling based on some of the regional Fed manufacturing stuff, angling towards maybe being disappointment. But right now we're expecting expansion of 51.3. But then Friday, we have the jobs report. We've at times shrugged off the notion that what's good is bad and bad is good. But we have seen a steadily rising unemployment. The SOM rule has been triggered. We've seen it within the adjustments that we've seen 818,000 jobs that vanished overnight a few weeks ago. The jobs market's not as strong as it was, whether you look at weekly claims data or you look, for example, at the monthly jobs report and the unemployment rate, right? So we're seeing the unemployment rate of 4.2% is expected, 4.3 announced last month. 164,000 jobs are expected to be added from the establishment survey. Point being is that the jobs market's been steadily softening, and it's reached a point where it's recessionary in terms of its indication. The reason why this is significant is that when you reach a certain point in terms of employment generally softens as you're entering recession. On top of that, we have the Fed coming up. They're going to announce a likely rate cut, 25, 50. We'll have to see. Maybe the jobs number that coming up this week might influence them. But the point is this. If the Fed is cutting right now, we can look at IRX. IRX represents about where the Fed funds rate is expected to be. They changed the symbol. I got to fix it. Okay. We're down here at 49.5. Well, the Fed funds rate's up here, right? The market is pricing in greater than a quarter point cut right now in terms of the Fed funds rate. We've seen a significant buying in 3-month T-bills. And so the point is that if the Fed is cutting right now, it's not doing so because we have inflation problems. We still have inflation problems, right? We're doing it because of the economic data is softening, right? And that's the reality. The 2 and 10, we don't have a chart for the 2s, but if we look at the 5-year FVX CGI, we'll see where the 5-year yield is. Dropped today 3.5%. Well, I guess it makes sense that utilities and staples are higher today. Utilities especially because it's more interest rate sensitive. But the reality is of this is saying, look, the market is pricing in weakness, right? The Fed rate cut is a sign of that weakness. And when you get bull steepening, we start to see that 2 and 10 go from inverted to being uninverted. That typically is very close to a recessionary type signals, generally within a year. Well, guess what? The S&P prices and stuff, how much in advance? 6 to 9 months. So while it's possible the market to test new highs on other factors, right? We may see leadership and utilities and staples, and maybe technology's done selling off for the time being, and we consolidate for a while. There's lots of reasons why the market could potentially test a new high, but we can't ignore the fundamental weakness that's happening right now in the economy and the market. And again, you take a look at Nvidia. This was the most important stock in the market. Guess what? It still is. Well, let's talk about the most important currency in the market. The most important currency in the market right now is JPY. That's the Japanese yen, as it was fueling the carry trade that was benefiting Nvidia and driving that beyond what it probably should have given the fundamental considerations. We're seeing right now in the dollar yen, the symmetrical triangle. It looks like today we just broke out of that. So while the markets held it together, only down to 0.2%, the Japanese yen broke through the lower point here, and we've got a level of support around 143.50. We might be on the verge of another buying spree in Japanese yen, which means what? You're selling dollar-denominated assets. Maybe that's Nvidia or other companies like that. You're converting it to dollars, converting it to yen, which is going to cause this to go down, and selling dollars and buying yen and then paying back loans. Again, I don't think the carry trade's done unwinding yet, and all you got to do is look at historical charts, and it will tell you there is more room for the yen to fall. There's more pain to be felt for U.S. assets being propped up by the carry trade from yen into dollars to dollar-denominated assets, treasury bonds, etc. There is more pain yet to come as this may unwind substantially if the Bank of Japan is truly on hold, and if they're in a rate hiking trajectory and we're in a rate cutting trajectory. All of a sudden the free trade, the free ride is gone, and we're going to start to see more pressure being born as the yen strengthens against the dollar, and this unwinds further. So again, what does this mean for you right now? It means that you got to be more cautious, right? Don't be those guys that think, hey, we had a bunch of stocks we just lost a ton of money in. Let's just double down on one stock and see if we can drive it in the near term and hodl. Let's be diamond hands. No, the reality is buy and hold does not work. It never worked as a retail investor or as a passive index investor having your money with the broker, right? And them an advisor and them saying, well, just diversify. Well, guess what? Diversification didn't work in 2008 during the financial crisis as bonds sold off. And guess what? HYG. So we saw the rally in treasury bonds. Well, guess what we got yesterday? We saw selling in the high yield credit markets. We saw risk spreads blow out. Guess what? That was similar to what we saw back here on August 1st before we saw further selling. Yes, we held it together today. Yes, it's different today than it was on August 2nd. But what we're seeing right now in the markets and even in the volatility markets is that the selling phase may not be done. And I say may because I do not have a crystal ball. But what I can tell you with SKEW ramping up to 163, the last time we're up here was around June 13th. Let's go back to the S&P. That was back here during this phase right here. Yes, we squeezed the top and then we dropped. By July 21st in here, we had significant signals we're about to sell off again, right? Well, guess what? We got it. Sorry, it was July 21st. It was back here on June 18th. June 18th, we had similar signals that we got back here on the 16th. Back in June 18th, the market was going to see a 5 to 10% correction. We went popped, and then we dropped 10% from the highs. Again, we're in a very similar position right now in terms of SKEW, in terms of volatility term structure back here on the 16th of August. We just barely broke away yesterday. We faded a bit today. So just realize if you've taken profits, if you're positioned so you can hedge, this is where you probably want to do so or probably should have been. And again, you're just sitting back and watching the volatility unfold. And back here on the 18th, we walked through how to put on a hedge or roll a hedge and put on a new hedge. And again, that's just barely acting right now, activating. If we get below this kind of 544 level in the SPY, it's going to start to kick in. Not much distance from where we currently are. So right now, those are kind of following that script. You're sitting back and waiting. Let the volatility unfold. We'll roll down those puts. We'll buy back the call spreads. We have a hedge that we didn't pay anything for. We're protecting our portfolio. We're giving a little bit of upside away if the market rallies from here, but you're taking away and removing the downside by taking profits and hedging. You cut your risk in half, at a point where the market right now has a vulnerability to the downside. Again, yes, the bulls out there saying, we're in a bull market. Really? Are you? How do you define it? Number two, again, it doesn't mean we can't have a correction here of 5 to 10%. So what are you doing to prepare for that event? Probably should be taking profits, right? Stuff like XLU that was up nicely today. Not a bad time to take a little profit here, because guess why? We may see ourselves, if the market corrects, the entire complex is going to be dragged down. Okay, August 5th, that was back here. We went from a high of 75.60 down here to 72. 5% drop, right? So again, do you prepare for that? Just sell into strength. Well, people were doing that today off of the highs. The volume today was significant. We have a slightly bearish candle because the shadow is twice the length of the body. And again, we're vulnerable here if the market begins to break support. Financials should break away from this level. Utilities, while may outperform the S&P 500, should break free from this level. Staples right now, elevated, extended, may see some degree of retracement. And look, if we just get a 50% pullback of this last kind of swing right here, we're talking what, 80 bucks, 80 and a half? I mean, that's nearly what? It's $3 on 83. It's about 3-4%. Again, why not take profits into strength if you've been trading this kind of rally here in Staples? Again, doesn't mean you have to go to cash, but again, just reduce your exposure in case the market does break down. We start to see further pressure. And boy, if we look at XLRE's done great. But what if high yield credit? What if junk bonds start to sell off? Borrowing costs start to rise. It's going to pressure XLRE. What's holding it up right now? Yes, treasuries are rising in anticipation of a Fed rate cut. Yields were down at 0.76 on the TNX today. Again, that's a decent amount here. But if treasury yields, long TNX, TYX are chasing down the Fed funds rate, what that's telling you is that we are not looking at growth ahead. We're looking at stagnation of the economy. We'll get a further confirmation this week in the jobs report. So again, if treasury yields are falling down with short-term rates based on a Fed rate cut, that is not a bullish sign. That is a further, maybe a bull steepening. We might see it pop into uninverted territory because the 10-year now is higher than the 2, but it means the entire complex is falling. And it means the outlook for inflation is diminishing to some degree. And again, that's based on a lack of growth expectations. So again, we'll get data this week that'll give us some points on that. But again, this is more of a warning sign to say, look, prepare for a pullback. It's reasonable. And certainly the timing right now and the volatility markets are signaling, hey, we probably have some further downside before we find some grounding in the market. And again, is it 5 to 10%? Is it more? Is it less? We'll wait and see. We'll follow the volatility markets. We'll determine when those markets tell us, hey, we're about there or we're there. Right now, it's just not looking that way with SKEW rising. The VVIX taking off here, not at 150. We're down here at 123 right now. This can really pop just like we saw in early August. Probably not going to see a VIX of 65. Can we see a 30 VIX? Absolutely. Okay, so just be prepared. And we'll see how this week unfolds and how the data comes out. And I'll see you on Friday for our Friday Theo Live event in the morning pre-market, about 30, 45 minutes before the market opens. All right, folks, have a great one. Catch you back next.